this is always a good one to come back to, especially with what's going on in the markets in the banking sector, across multiple other sectors, the reaction of some of these tech stocks, Bitcoin, what have you. It's always good to review this and understand how implied volatility affects different products and how different products premium will have different strikes for one standard deviation, which is a reflection of implied volatility, I guess, points on a distribution graph, but also how raw implied volatility can differ between products, and we'll show you how that visually changes where you might have your strikes and premium levels and whatnot.
Let's do it.
Let's do it. Implied volatility basics. So with implied volatility, from a textbook definition, we're talking about the expected move of a stock given a 1 year period. And implied volatility is always presented on a one standard deviation basis. So if you're just looking at nothing other than the actual implied volatility of a product, that's how it will be presented. One thing to point out though, and this can't be stated enough, is the fact that implied volatility doesn't change the option prices. The option prices being expensive or cheap is what drives the implied volatility number. So it's always the option prices and utilizing the option prices and other inputs of the Black-Scholes model to get to implied volatility numbers. It's not the other way around where we have this implied volatility print and we're backing into the prices. We're taking the prices and we're backing into the implied volatility number. It is certainly a representation of uncertainty. So the higher the implied volatility is in a product, the more you should expect it to move day to day, week to week, month to month, and the more uncertainty there is. I think the easiest way to think about it is like when you're looking at IBM that hasn't moved in 10 years, it's going to have a low implied volatility. Where if you look at some other product like Tesla or a pharmaceutical company, those are going to naturally have a higher implied volatility because there's more implication of movement than something that's just been stable for many years.
Yep.
TLT, another low implied volatility product, gold, things like that. Low implied volatility products doesn't mean they won't move. It's just that their daily, weekly, monthly movements are projected to be less than something like a Tesla.
Yep.
When you're looking at, we can go back real quick. Yeah, so it is not a linear value when we're looking at implied volatility. We did a great segment with Jacob on this, and it really highlighted why we've kind of shifted towards calendar spreads, diagonal spreads for strategic reasons. But the closer you get to expiration, when you're looking at the raw implied volatility numbers on the platform, I saw a question in the YouTube chat about this, but the raw implied volatility numbers are just the numbers on the right-hand side of the tastytrade platform. So when we're looking at these numbers, you're almost always going to see the numbers increasing as you get closer to expiration because we're adjusting that 1 year time frame that I referenced earlier. We're adjusting that to have less than 365 days. And when you do that and you analyze the premium, what you'll typically see is that there's more implied volatility premium in the near-term cycles than further dated cycles that are going to have more time premium or time-based extrinsic value. So it's not linear. It's almost always going to slope higher in terms of implied volatility exposure as you get closer to expiration because most of that extrinsic value that exists in that cycle is going to be implied volatility based, or at least more so implied volatility based than time value based.
Yep.
Implied volatilities are going to differ from month to month. Typically, again, you're going to see higher implied volatility values from a raw implied volatility standpoint get higher and higher as you get closer to expiration or have less days to expiration. But you'll also see little spikes and blips on your little implied volatility radar depending on whether there's a binary event or an earnings announcement. So like yesterday when we did the XSP trade, you could clearly see there was a spike in implied volatility in the S&Ps because the market was expecting volatility from the CPI report. That's a binary event situation that we've been seeing over the past couple of months. Didn't necessarily mean too much 5 years ago when rates were zero, but now that they've increased and we're looking at inflation, we're really focusing on these things. They're baking in implied volatility into these numbers coming out, and you can clearly see that, especially in the S&Ps. It's very similar to a regular earnings announcement that might come out. Yep. And last but not least, the price of the stock doesn't imply that there's going to be higher or lower implied volatility. It's really the product that you're looking at is a totally different animal than another product that you might look at 10 minutes later. And for that reason, you can't just look at the VIX and be like, oh, the VIX is high. That means every single product that I'm looking at has high implied volatility. It might mean that the implied volatility of that product has increased a little bit, which would reflect an increase in IV rank or something like that. But when you're trading a product, you really need to have a full understanding of the implied volatility for that product itself, how that weighs against the historical implied volatility, et cetera, et cetera. So different stock prices, higher price stock does not mean it's going to have higher implied volatility. And that also rings true for lower price stocks. Doesn't mean it's going to have low implied volatility.
Beautiful.
Glorious. Nice little visual here. You love to see it.
Yeah. So this is a representation just generally of your strike proximity based on volatility, right? So this is just an example of why we're looking for high volatility, all else being equal. Of course, there's other risks that come with high volatility underlyings, but if you're looking at something that's got 30% implied volatility, your strikes are going to be rough, are going to be much closer to the stock price. And when you have something with 80% implied volatility, it's going to be much further out of the money. And so, your proximity to where the stock is trading or the ETF or whatever you're trading, your proximity to it is going to be much tighter with lower implied volatility. You're betting on movements, the implied movements and the movements that are priced into the options, understating already low implied volatility. When you're selling something when volatility is at 80%, you have a much wider range to hit where the projected movement has a lot more room to actually move. And that goes with the amount of payment on that risk that you're taking, right? So if we jump to the next slide, it's that same dollar at a 30% implied volatility, you're going to be much closer to the stock price. When you've got 80% implied volatility, you're going to be much further out on the curve. So you're getting paid the same amount relative to this position, whether it be 30 or 80% implied volatility, but your actual price risk is much closer at the money when volatility is low. So that's why we say if we're looking at two products that are the same price and have the same strikes and the same time till expiration, we prefer selling higher volatility just because you have more wiggle room for the price to move. You're getting paid that same amount for further out of the money options. It's just a way to capture a higher premium and have a more wiggle room for the stock to move and more premium when you roll out in time. There's more management you can do. You're getting paid to keep risk on a lot more than you would with lower implied volatility. It's all those, all those are positives. There does come a point, and we've talked about it with the bank stocks and with some of these biotech and pharmaceutical companies where you're not really trading volatility. Like, it's reasonable to assume that KRE, which was 80% implied volatility yesterday, might go down to 40 or 50% implied volatility. That's generally where it stays. Is it reasonable for something that's got 300% implied volatility that's in a biotech space to go down to 50% implied volatility? That's not a reasonable situation to play into, and that's why we look for stuff that has reasonably high implied volatility, but is also, something that can come down in volatility. And you can look at that via IV rank, which is what we use to measure whether IV is high or low relative to itself.
Yeah. And when it comes down to trading different product types, so like if I'm looking at an ETF that has 30% IV, fine. If I want to sell strangle and just roll it forever, fine. But in the equity world, do I want to really sell a strangle in a product that has 30% IV? Probably not. And why is that? Well, it's because equities have earnings, they have boards, they have CEOs, they have things that they can say that move the stock dramatically. And if I have risk on both sides of the market and I'm in a tight range, I don't necessarily want to have that on, because you're betting against movement in the stock price, and equities can and do move pretty aggressively sometimes, even the low IV ones. So how do you get around that? Maybe you just sell a put. Maybe you do a Jade Lizard instead. Maybe you don't have risk on both sides. But there's no really right or wrong answer. But that's kind of the idea of, looking for high implied volatility situations to where you can set your strikes or plant your flag, like this 80% IV example, where now all of a sudden you're able to get way further away from the stock price, still collect that dollar. And I think KRE is a perfect example in this case, because it's up $3 almost today. Mm-hmm. It's up 6%. But if you look at the call values in April, they're unchanged, or they've gone down in price. If you look at them in March, they're all down, even into this $3 rally. Now, why is that? You might expect that they would be increasing in price on a rally, but implied volatility contraction can be a powerful mover of an options price. And in this case, in KRE, like we talked about how yesterday was literally in the 80s and now it's at 65%. That's a massive implied volatility contraction. And that implied volatility contraction can offset a ton of directional risk against you. So like the 50 strike, the 51, 52 in April, all of those are basically unchanged even into this rally, because you saw something like this where if you sold the call in 80% IV and now it's going down to 65, 50, 40, 30, it can really reduce the option price even against directional moves against you. So that's kind of where we want to live, getting into places or getting into positions that have high implied volatility with the expectation of that implied volatility coming down.
Yes. Good stuff. All right, now we're getting into the weeds a little bit with the kind of, we gave the basic explanation over those last couple slides. Now we're getting into the more granular stuff. So a lot of people look at or wonder why we don't really look at IV per strike, and this will kind of explain why. But implied volatility exists as well for each option strike, and per strike implied volatility, it's shaped like a smile for the most part, if you're looking at a stock that has no skew. Now, most stocks do have some sort of skew. If you're looking at like an ETF or something like Apple, they're going to have downside skew. When you're looking at like a Tesla or something that more high flying, a biotech, something like that, you might see some upside skew. But generally speaking, you see a sort of smile like this, where implied volatility of further out of the money options is going to be much higher than at the money options. And the reason we don't look at per strike IV is because this really isn't the IV that you're trading. You're trading the general IV of that product, and when you're trading, a one standard deviation option versus a 30 delta option, there's not a ton of difference in implied volatility. The implied volatility difference really happens when you get out on the tails, because those further out of the money options have a higher per strike implied volatility, and it's relative to the price change of those options. So when you think of it like the example we have here, if you have an at the money option and it's trading for $1, it has a 50 delta, and that option goes to $1 and a penny, right? 101. That change is much less relative to a 10-cent option that goes to 11 cents. It's the same penny difference in value, but the percentage change of that option that goes from 10 cents to 11 cents is much greater than the dollar option going from $1 to $1.01. And so that's why per strike volatility has this shape, is because the penny options going to 2 pennies is 100% change in value, whereas that change, that actual value change for at the money is much lesser. So this is just generally what the shape of volatility looks like when you're looking at per strike, and why, it's not really that important for us to look at. It's a good concept to understand and to realize that this exists in option pricing and markets, but it's not something that we granularly look at and be like, oh, well, this option has 90% implied volatility, so I'm going to sell that one or buy that one or whatever the case may be. That's not what we're looking at.
Yeah, and ultimately, cheaper options have a greater chance of multiplying than more expensive options.
And that's almost like a duh,
But that's all this really is.
That's all that is.
Yeah.
All right, so jumping to the next one, which is what you'll see most of the time with implied volatility of per strike when you're looking at an underlying, is the IV smirk. And the smirk represents the priced in skew of downside risk, right? So we talk about generally markets in like ETFs or something like Apple, something like that. The structure is kind of an escalator up and the elevator down, right? The velocity of risk being to the downside, the big move to the downside being greater than the small moves to the upside. And that's priced into markets. And so you'll see implied volatility per strike, again, with this sort of shape, where if you go 20 points out of the money, you're going to see higher volatility on those puts because the velocity of risk is priced to the downside. So generally speaking, when you get out on the tails, and I shouldn't say really 20 points out of the money because it depends on what you're looking at, but when you're looking at tail options, the implied volatility of those options are going to be much greater on the put side than on the call side because of the skew that's baked into most underlying. So when you're looking at a SPY or an Apple, you're typically going to see this downside volatility skew on a per strike basis. If you're looking at like a biotech or sometimes Tesla, stuff like that, where the skew and the velocity of price movement is actually priced into the upside, you'll see that implied volatility higher on the calls.
Yeah, and I think this is an interesting one because when we talk about SPY specifically, we've shown with the change in options prices, a couple of weeks ago we looked at Tesla, but we showed that like if you're buying options and you're buying puts, if you get a down move towards your strike, your ability to make gains on that option are significantly less than if you were to do that to the upside. So I think it's interesting here, and this plays a role in that too, because if you're paying more to buy an option to the downside, your ability for that to multiply 3, 5, 10x is significantly lower because your starting price is higher.
Yeah, but that's the thing. That's what negates this smirk and why this doesn't totally work for longer duration options, is because the price input that goes into Black-Scholes is a greater effect than what the strike volatility is going to be.
Yeah, and it's just an interesting one to consider because like if I'm forced to pick one side, puts or calls, sell one side and buy another in SPY, I'm almost always going to sell the puts in SPY and buy the calls in SPY.
Yep.
For this reason itself, not including the Black-Scholes model, like you said, the input of the stock price, where if the stock does increase, that's going to increase the value of all options, but it certainly helps increase your call options too because you're paying a lower amount relative to the other side. Yep. So an interesting one, the smirk.
The smirk.
Yeah.
Yep. All right, and lastly, this is kind of where the concept of per strike volatility comes into play, I think, or is more applicable, is when you're looking at shorter duration options. So we talk about how most underlyings that you look at will have a volatility smirk on the downside. When you get to the shorter duration, and this goes to the point that we were making in the beginning of volatility being higher as duration is shortened because the binary nature of just having a couple days is much greater than a couple months of price movement. So as you get closer to expiration, or if you're looking at closer to expiring options, you're not going to see the same sort of shape of per strike volatility, and really the skew as an effect won't be as great because the probability of price movement is more so 50-50, right? So the longer duration you go, for the most part, with all options is pricing in that time has the most value, right? And that maybe you go up 3 days in a row and then you go down 3 days in a row and you're flat, right? When you're looking at shorter duration options, let's say 1 day or 3 days or even 10 days, 7 days, you don't have that. The probability of that happening is much smaller, and therefore the volatility of that underlying is projected to be a 50-50 shot when you go into a short-term option, and thus you see not much of a skew in the short term unless there's a binary event coming in. You could see skew flip around and change. You could have something like a Tesla have call skew in the weekly expiration going into earnings and then put skew in the back. I mean, those are just an effect of short-term option trading and pricing of those options based on supply and demand of those positions.
Yep. And that's literally not necessarily the skew, but that's what we did with our XSP trade, where we saw that there was heightened implied volatility in the 1 day cycle because of the CPI report. That was also heightened because of just the general market movements that we were seeing. And we got, a move up, which was basically to the expected move. In the back months that we bought didn't really reflect that same implied volatility spike because it was more time value associated, and you didn't really see too much of a contraction in implied volatility either. So when you're buying that option that didn't really contract, didn't really have too much of an IV exposure, and then you're selling the option that has a ton of IV exposure, almost all IV exposure, and you see that just get decimated, that's your best case scenario.
Yep.
Beautiful.